Good afternoon and welcome to the S&U PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Anthony Coombs, Chairman. Good afternoon, sir.
Hi, good afternoon. Yeah, well, great to see you all. We're big fans of IMC. We think it's a tremendous way of communicating with and keeping in touch with both our existing investors, very often retail investors, and also potential investors. We want more people to invest in our company because we believe in what we're doing and in the long-term sustainability of it. I'm just going to introduce our half-year results today. I think you know the gentleman I've got with me. We've got Ed Ahrens on my left, who is Chief Executive of Aspen Finance, that's our property bridging business. On my left, I've got my brother, Graham Coombs, who's Deputy Chairman. On my immediate right, I've got Chris Redford, who's the Group Finance Director. And on his right, we've got Graham Wheeler, who is the Chief Executive of Advantage Finance, which is our motor finance business. I'm Anthony Coombs, and I'm just going to tell you, first of all, that we continue to trade well as a business. We've got a very strong team. We must say that we don't live in the most propitious times because obviously cost of living pressures, higher interest rates, some regulatory interest in the financial services sector has obviously produced headwinds which we have to deal with. But we're very confident that we can and are doing precisely that. Unfortunately, all those things do have an effect on the valuation of shares on the British stock market. I'm sure you're all aware of that. But hopefully, we think that the corner will be turned in a year, 2 years' time, particularly if we ever get a Conservative government. And I think you'll know where I'm coming from when I say that. But anyway, in the meantime, we're trading well. We think that the markets that we're in are extremely good for long term, both the motor market, because it's basically utility. People need cars and well-priced cars in order to be able to get to work, to do their shopping, to take the children to school. And we think that that is a great business to be in. And also the bridging market, basically we're playing into a situation where there is a substantial shortfall in the supply of residential property in this country. And we are able to take advantage of that and help people who want to add to the supply of housing. So we're busy laying the foundations of what we hope will continue to be a very successful business in the medium term, irrespective of, as I said, the headwinds in the shorter term. So if we can turn to the next slide, which is the highlights, the next slide but one, the highlights of the half year, the 6 months to July. I won't go through these in detail, you're able to read them yourselves, but I think group profit before tax, a little bit ahead of last year. Earnings per share is down, not because our profits are down, but because our government has decided that the 25p corporation tax rate has been introduced, and obviously that is slightly taken down our earnings per share. But the net receivables in the business are increasing, and so they should, because we're in growth markets. Although we are being cautious in terms of our outlook on those markets for reasons which I'm sure you'll find are obvious. We're holding the dividend at 35p a share for the first half, because we think that's the prudential thing to do, particularly given the EPS effect from the increase in corporation tax. But nevertheless, we do have a very strong balance sheet in our business. We're soundly financed. Chris Redford on my right has done an excellent job in making sure that we have more than adequate facilities for expansion. We're £280 million facilities now, and we're using, Chris, what, about 183 million of them?
About 190.
Sorry, 190. It goes up and down depending on our very much our bridging business. So all things very solid. There are some headwinds. We're not going to be hubristic. We're not going to be Panglossian in terms of predicting the future. But we think that we will do well and continue to do what we've always done, which is to serve the interests of our customers better than we've ever done before. So with that, I'm going to ask Chris to turn over to the group financials. Next slide, please.
Thank you, Anthony, and good afternoon, everybody. Thank you for joining the webcast. Just going to give you some highlights from the financial performance. This one's the income statement. So if you look down the income statement, we happily got more revenue than we did in the first half last year. That was driven by bigger book going into the year. Growth has been a bit more cautious, as Anthony mentioned, in the first half year, but that revenue has gone up nicely, and we've needed that to offset so there's some slight headwinds with admin expenses up there. Those of you who joined the webcast at year end may remember that last year, in line with inflation running away with itself, we did give our staff a couple of increases last year. So that's fed into the admin expenses increase, plus some extra costs with people like FOS, etc. The even bigger increase and the headwind that we've had to face is finance costs. So we pay a variable rate on our funding, as that's gone up from just over 0% a couple of years ago now to 5.25%. Therefore, albeit it's capable within our model, it has increased a lot, as you can see there. Allowing for these headwinds, though, the revenue has helped us still grow our profit, which we're very pleased with. So you can see we've gone to 21.4 million in the first half this year against 20.9 last year. If we could go to the next slide, please. So this is the group balance sheet. Still a very simple balance sheet. It's all about receivables, borrowings, and equity. There's not a lot else going on. If you look on the receivables, we split that here so that you can see what the growth has been since July last year in motor finance. You see that's up 12%. Property bridging up 16%. Motor finance in particular was helped by a very strong second half last year. So the growth in the first half this year has only been 2%, but that has helped still the revenue line, as I mentioned before. Aspen bridging, strong growth since last year. It's actually gone down slightly in the first half this year, the book debt, but it's quite a lumpy product, and certainly the way quarter three started, I think we're back on the growth trail in terms of that, in terms of year-on-year growth by the year end, I suspect. We've mentioned the committed facilities on the borrowing side, and you can see that at the half year they were about 184 million. As I say, I mentioned a more recent figure to Anthony just now of over 190 million. If we can go to the next slide, please. We generally show you this slide. It's the where has all the cash gone slide. So you can see here the group cash on the left-hand side, and then we show you how the cash is being used in our two excellent trading businesses. So Advantage in the middle there, you can see still strong basic monthly live collections, and Graham Wheeler on my right will say a bit more about that in a minute. And on the further right, you can see how Aspen have used their borrowings during the half year. You can see a very strong repayments figure, settlement collections, 46.3 and 30.7, and with some of the stresses in the housing market and with interest rates, we're very pleased with that figure. If we could go to the next slide, please. During the year, Anthony may have alluded to this, we did a new 3-year club facility. That's going to end therefore in May 26, but it's got some capacity built into it. It's what's called a 3+1+1. So potentially in 9 months' time, I can extend that again by a year if both parties agree, and then another year, 12 months later. It's also got an accordion facility built in where, again, if both parties agree, we can add to that facility if we need to. At the moment, the headroom is very good, so we probably don't need to. So we talk about committed facilities and when they mature in the second bullet point, and then just how the cash has moved in the third bullet point. So without further ado, I will hand over to Graham Wheeler, who is the CEO of Advantage Finance, and he will tell you a bit more about the business.
Okay, thanks, Chris. Good afternoon, everybody. So the first slide I talk about is our sales performance. So there's two charts in there. One is the mix of business that we are lending to. We categorise our customers into 5 tiers of business, A to E. And the chart on the right-hand side is the movement in our average interest rate in terms of our new lending. I guess what that shows you is that our volumes are very consistent. Our tier mix is very consistent. Whilst we're slightly behind budget in terms of the cases financing, because of the increased average lend, we are over budget now in terms of the advances. So that puts us in a very strong position moving forward. The tier mix is very stable. The average customer score in terms of credit score is very stable as well. And we've been spending this year making small increases and improvements in terms of the mid-quality customers, the kind of B to D categories that give us the higher margin, which has helped us to manage our overall interest rate margin moving forward. On the chart on the right-hand side, in terms of average rate, what we see in there has been a dip in the final quarter of last year as we tested the market for lower margin but higher quality business, which was actually, in terms of volume, very successful for us, and has a knock-on effect in terms of collections, which I'll show you in a couple of minutes. Since the gradual increase in interest rates since the turn of the year, we've obviously moved both our interest rates and our tier mix to help protect some of those margins moving forward. So we are kind of doing our best in terms of those interest rate headwinds to manage the overall margin of the business. The next slide, please. Now this slide there's 4 charts on there in terms of customer payment update. The top 2 charts are actually information that we look at every single day in our business, which is our live cash collected performance. And what those 2 charts shows, one is the percentage of live cash, and the other one is the monetary live cash volume that we've got. The light blue line is the budget, and the dark blue line is actual. So you can see on the chart on the top left-hand side, we're regularly collecting more than budget in terms of percentage, and that's a 94-95% of live cash during the course of the first half of this year. If you think about the headwinds created by cost of living and the sector of the market that we're operating in, to be collecting 94-95% of live cash in our marketplace is extraordinary, and long may that continue. The chart on the right-hand side at the top is the monetary value, and that shows you that we are collecting ever more in terms of monthly income, and that puts us in a very strong position. The 2 charts at the bottom are kind of more cost orientated. One is our bad debt rate on the left-hand side, and the right-hand side is our voluntary terminations rate. And you can see that we're pretty much on budget, but slightly better than budget in terms of bad debts. And in terms of voluntary terminations, we are substantially under budget, which is a good thing, because with controlled bad debts and a better than expected performance in voluntary terminations, that has a real positive effect in terms of our cost line within the P&L. And we'll pick up again. I'll get a little bit more detail on that later on. So overall, from a collections perspective, it's a really good news story. We're collecting better than we expected. We're losing less than we expected, and that's got to be a good thing moving forward. So if you don't mind, move on to the next slide, please. So this slide is about, I guess, the regulatory landscape that we're currently working our way through, and the Financial Conduct Authority they're very active at the moment. They're very specifically active in the motor finance market. And there's been a number of different inquiries that we've been working our way through with the FCA in terms of the market segment over the course of the past actually couple of years. I think driven by some of the concerns they had in terms of coming out of the pandemic, and secondly, driven by the cost of living increases. So we've been working with the FCA on a number of issues. around affordability, around financial resilience, around our collection processes and forbearance review, and in terms of consumer duty. Where we are at the moment is we've successfully completed all of the work required to be ready for consumer duty. Consumer duty went live on the 31st of July this year. We had a kind of readiness audit by external auditors to make sure that the work that we had been doing in the 12 months previously were going to come to fruition and that we would satisfy the requirements of consumer duty. And we sailed through that audit quite easily. So we're, I think, in good shape with consumer duty. We've completed the detailed affordability inquiry from the FCA as they looked at all lenders in our sector in terms of their data and processes for underwriting customers, and we came through that process well. We regularly report in terms of financial resilience, but I think that was stemmed from the FCA having some concerns on non-bank lending companies, non-bank owned lending companies, and we all have to report quite regularly to the FCA in terms of our headroom and from our treasury position, which actually Chris has already spoken about. A couple of things we're currently as work in progress. The FCA are having a market study review of collection processes and forbearance, and we're working with the FCA on that particular issue just now. And it's too early really to say too much about that at the moment. It's work in progress. The last thing is a market issue that doesn't affect Advantage, but something to be aware about on commission disclosure. I think the Sunday Telegraph 2 or 3 weeks ago made some comment about this moving forward. It's likely that the Financial Ombudsman Service will make some decisions that will ask particularly prime lenders to pay some commission back to customers because they didn't disclose the amount of commission, which, strangely enough, the regulator never said that lenders had to announce the amount of commission, but they had to announce the existence of commission. But that's moved on now, and there's some risks about the overall marketplace in terms of commission disclosure. For Advantage, we're in a lucky position in that we never offered the type of commission that is being outlawed by the regulator. We offer a flat fee commission to our brokers. So that's meant that the 3 legal cases that we processed, we won them all against claims management companies. And we've had about, I think, 24 or 25 individual decisions come back from FOS, 100% of which are found in our favour. So we're pretty sure that issue isn't going to affect Advantage, but actually in the long run it might benefit Advantage, because as the prime lenders focus their businesses on possibly redressing some customers, they may take their eye off the ball in terms of lending to new customers, which might actually create a bit of an opportunity for us moving forward. So lots of activity taking place with the regulator, and not just the FCA, but Financial Ombudsman Service as well. And we work our way through that to the best of our ability. So that's an update in terms of where we are with the regulators. I've only got a couple of 2 or 3 more slides left. You wouldn't mind flick on to the next one, please. This just gives you a feel for just how much we've been investing in systems and automation over the course of the past 12 to 18 months. I'm not going to go through all those different individual projects, but I'll name a couple. The settlement portal was there to allow customers to get onward settlement figures for their accounts. Previously, they had to call in for a settlement figure, and that could be sometimes 500 or 600 calls a day. And we've found a way to automate that whole process now, which has effectively saved about 3 or 4 man hours, 3 or 4 man days, in terms of staff that could be redeployed into other areas. And then the other thing, which has had a huge impact on our business over the course of the past 4 or 5 months, has been the voice analytics project, where we identified through consumer duty that we had a potential weakness in that we couldn't gather evidence of all the great customer conversations that we're having to help solve the problems. And what voice analytics does is it records and transcribes 100% of the calls straight onto our contract management system, which actually allows for further analysis later. But quality checks customers and it provides a training process for our staff that if we identify any issues quickly, we can identify that issue through the voice analytics system and go back and retrain the staff. So it means that the level of service we provide our customers is significantly improved. So that's that slide. Moving on to the next slide, which is, well, what have we got in the roadmap for the next 12 to 18 months? Well, similarly, a huge amount of work, most of it focused on building efficiencies and automating things and providing better service to customers. One of, I guess, the only one I'll pick out from that chart is a customer portal, which has really not been done in our marketplace to this effect. We're developing that as a tool to allow customers, those great customers who don't really need our help, to look after their finances for themselves. And if you flick onto the next slide, please, that just gives you a feel for the tool that we're working on to provide, that we'll introduce between now and the end of the year, where customers can self-manage a whole range of different processes for themselves, which means that we can focus our efforts in looking after the customers that need us most. So I think that gives you a feel for the sales perspective, the collections perspective, the regulatory position, and the developments that are taking place within the business. And at this stage, I'll hand back to Chris.
Thanks ever so much, Graham, and some great stuff happening in Advantage in the first half of this year. We do show you some longer term slides as well. If you could just move to the next slide, please. This is just an update slide. We do this on a consistent basis. So this is our new business at Advantage. What profile has it got? How many loans have we written in the first half year? What's the average level of advance? You can see all that on this slide. Interest rate, as Graham alluded to earlier, that's nudging up a bit now. And you can see the original term that we lend over. So that's just, again, an update slide. If we go to the next slide, please. This is an interesting one. So this is to do with first repayment quality. The blue line on the chart on the left-hand scale is how each tranche of customers over the last, effectively 20 years have made their first payment. And that's shown by the blue line on the graph, and that's varied in the early stages when we were doing manual underwriting. That was down near 90% of customers making their first payment on time. You can see how the increased automation and skill of the scorecard and the underwriting and Advantage took that up to near 96, 97, and at one point even 99%. And then as competitions come in about 2016, you can see that falling back to a more natural level of about 96, 97%. And other than that yellow piece on the graph, you can see on the blue line, that's where we've been, since, not through the pandemic, but recently you can see that's nudging up again. Why is this chart so important? Well, it's really the red line as well. So you can see how the red line on the chart and the inverse scale on the right-hand side, that's the number of accounts that's gone into bad debt in the 5 years of term of the deal. So you can see that on the red line. You can see how well that's correlated over the years with the blue line. So if customers tend to make their first payment at a certain level, then we can pretty much try and predict on the red line what the outcome in terms of number of bad debts is going to be after 5 years. So that's worked quite well. You can see up to 2018. Obviously, after 2018, we don't know what the 5-year outcome is because we haven't had it yet, but you can see from the blue line what that trend is. And if you assume the red dotted line, which is also shown on the chart, which is our estimated bad debt after 5 years, might follow the blue line as well. Hopefully that's of interest to investors as well. If we can have the next chart, please. The next chart is more of a snapshot. So it's comparing, particularly our live book, 65,000 customers roughly at the end of July versus 65,000 customers roughly again that we had at the end of January. And you can see how that's moved during the 6 months. There's a little bit of seasonality here in terms of people don't tend to pay as well at Christmas, but even allowing for that, we've gone from 46,000 up to date to 48,000 up to date, 76% of the live receivables up to 78% of the live receivables. And we're really pleased with that. And that reflects some of the trends that Graham showed very well in his charts in terms of how well our monthly payments are being made by customers at the moment. So if we could have the next slide, please, and I will hand over to Ed Ahrens, who is the CEO of Aspen Bridging.
Thanks, Chris, and good afternoon to all. So good progress at Aspen in the first half of the year, but on a cautious basis. Record PBT for the half year, but importantly on a quality book. It's been a challenging period with interest rates rising and property values, but we've risen to that challenge, and we've reduced our LTVs on the book and on the new loans, and we've also taken a more cautious approach to underwriting. So basically repositioning ourselves in a marketplace. And although the receivables have come down a bit since the beginning of the year, we've actually built a quality pipeline that we expect to fulfill on through the rest of this year. And reinforcing the book quality, we've had a strong performance in terms of collections, and we expect to have a positive outcome on those 15 loans through this year. So our overall view is that we remain cautiously positive about the opportunity in the market for Aspen. Next slide, please. You can see here the performance over the years. And if I take your eyes to the right-hand column in terms of the first 6 months of this year, you can see that the average gross advances are pretty much where we expect them to be. In terms of the cost of sales, we're in control of those costs of sales, and you can see the trend over the years. We've been helped in the first half of this year with returning customers, and that's reduced the amount that we've paid away in terms of commission. And below that line, you can see the progress in terms of the LTV as described previously. We've also been working on the margins and increasing the rates through the period, and we're currently at 1.03 versus where we were at the end of the last financial year. And in terms of all other aspects, it's steady as she goes. Terms are the same as they have been for quite some time, and these are good loans that we're putting on the books. Next slide, please. Just draw your attention to an update in terms of where we are on our focus for this year into Jan 24. On the left-hand side, this is really all about customers and brokers. We can see that we've got 15% of our new deals are repeat borrowers, which is very good news. We've obviously tweaked and we keep an eye on the horizon risks. We've increased our stress testing for refinance exits. And as we've described earlier, our approach on tightening our LTVs. We've done a lot in the first 6 months in terms of our broker development and industry attendance, and that's helped improve where we are on our work in progress cases. On the right-hand side, it's more operational and staff. We've deployed 9 projects to date, some of those involving the automation of letters, which improves our efficiency. We're looking to go live with our new website in Q4, beginning of Q4. And that's an important interaction with our brokers. And in terms of our staff, we've been concentrating on lifting their skills and providing them with accredited courses, some provided by the Association of Short-Term Lenders, and a number of people in the team have become risk qualified from a valuations perspective. And I hand you over back to Anthony.
Good. Well, thank you very much indeed, Ed. So I'm not going to repeat what I said at the outset. We are confident about the future. We're trading well, but we admit that we don't work in the most propitious economic and political climate at the moment, which is one of the reasons why the British stock market is valued in the way that it is. I'm sure you'll all be aware of that. However, we continue to work very hard indeed to improve our customer relations. The offer, that we make to customers and the way that the customers approach us. And to that extent, we really want to repeat what I don't know if any of you watch or see Warren Buffett's excellent podcasts and speeches, and he always talks about delighting customers, and that's really what we want to try and do in our business. And we're entirely focused on that, and that really leads us into the first pre-submitted question, which is about competitive advantage. It appears to have disappeared from my screen. One second, let me see. And it says, what do you think? Could we move the because I seem to have lost it on my screen. One second.
Yeah, I think it's what would you say is your competitive advantage over your peers?
Yeah, what is our competitive advantage over our peers? Concentration on customer service, customer experience is obviously very much part of that. But over to you, Graham.
I would say I could go on with this for ages, but there are two primary advantages. One is the quality of management experience. If I look at Advantage, has been trading for just under 25 years, and the majority of the management team have been with the business for that time. So these are people that truly understand how to successfully service non-prime customers. I think the average management experience and Advantage is something like, for the management team, is something like 20 or 21 years within the business as an average. So I think that means that we've been through all sorts of different scenarios and different cycles, which mean that we're well positioned to be able to handle anything that comes our way. I think the other big advantage we've got is, fun enough, in our management system, in that the contract management system that we operate is self-owned, self-developed, self-supported, which means that we are incredibly nimble with the ability to make fast changes to our system, very, very quickly and very agile. And that means that we can react and provoke the marketplace very aggressively. So I think those are two very strong competitive advantages over many of our peers. I could go on for ages on this particular subject, but I think we should stop at that point.
Good, thank you, Graham. Next questions are related, are from the same gentleman. I'm afraid I don't have his name here. And it basically suggests that we reduce dividends and put the money into adjacent businesses, which could mitigate what he sees as weaknesses in our current markets. I think we can say with some confidence that actually the market for our used car finance is not declining. If anything, it's actually, the size is going up. Why? Because where normally you get 2.5 million new cars produced every year, at the moment it's about 1.6.
1.8 this year.
1.8. Still, so 700,000 less than it normally is. That obviously has a good effect on used car values and on the demand for used cars themselves. And it's very interesting. If you look at the proportion of people now who are happy to have used car finance, it used to be, I think, about 32%, is now nearer 45, 46, 47% of the population. So that just shows an increasing market. And we'd say the same with the property market, which, although temporarily trending down, at least in terms of price, in terms of the long-term undersupply of housing in this country, very much is on the up. So
The rapidly rising population.
exactly. Yeah, good point. So what we would say is that we don't think it's sensible to reduce dividends for two reasons. First of all, we want to stick to our last. We don't really want to go into adjacent businesses, particularly at a time of economic uncertainty, about which we may not have the expertise that we do at the moment. And obviously, we'll look at any good business opportunity, but it would have to be a very good one if we're going to move away from our areas of expertise. And the second reason why we wouldn't do this is because we don't need to. I think I did say that we've got a very significant headroom in terms of our available finance through our normal financing mechanisms, and I wouldn't want to add unnecessarily to that headroom by depriving shareholders and the owners of our company of their due return. So I think that's where we are on that particular question. And I can now move on to Pat H's question, which I think originally also contained why the frustration that we have with regulators in the financial services industry. And the frustration is very simply this, Pat. We believe that the free market works very well. We're not quite all the way back to caveat emptor and no regulation at all, but there does seem to be in a recent trend over the last 15, 20 years that the market itself can't be trusted to deliver the very best outcomes for customers. And that seems to have embedded itself in certain parts of government. We, however, believe that the free enterprise system does work very well. It obviously has to be regulated, but it's the degree of that regulation. And we think that probably with a whole plethora of the Consumer Credit Act in our industry, consumer duty, conc rules, there is a continuing questioning of the way in which the industry works. And that has a bad effect. Why does it have a bad effect? One, because it means that we can spend less time improving our business for the benefit of our customers, because we have to deal with all these regulatory inquiries. And secondly, and possibly most important of all, and one recognised, I think, in the financial services industry, that over-regulation does inhibit innovation. People put new products, new processes, which might benefit customers very considerably, on hold, and that we don't think is good for customers in the long term. So that's our basic philosophy. Pat says, do you expect an S166 appointment or remediation exercise as an outcome from the FCA? All I would say, as far as that is concerned, is that one would always be unwise to try and anticipate what the FCA may suggest in any particular scenario. We do know from our contacts at the FLA that the FCA seems to be using the 166 mechanism far more widely than it ever did before in order to investigate practices within the financial services industry, and so it's impossible to say whether they would apply that in our particular case. What I would say, however, is that it is widespread. It is a means of investigation. We're proud of the way that we service our customers. We provide a service to them. And we would be very relaxed if a 166 application came our way, although obviously we don't necessarily welcome it or anticipate it, given the previous arguments I've made about regulation as a whole. So I hope that's an answer to you, Pat. Maynard P. The company has announced the forthcoming retirement of Graham Wheeler and the appointment of an external successor. Mr. Wheeler was appointed externally as well. Why has the board decided again that the best leader for Advantage is working outside the group? For a business that is quite rightly prides itself on its illustrious long-term performance, the absence of an internal appointment might suggest a lack of proper succession planning and management development within Advantage. Outside appointments may also risk not fitting in with the board's commendable culture. All perfectly reasonable points, but ones which have been taken into account during the succession and the selection process of Carl Werner as Graham Wheeler's successor. We recognise that internal promotion is very important. We've been doing this for many years, and indeed, 3 or 4 of the applicants for Graham's post were internal, but we do feel it's important that we have the best person, the best fit for the job, and Carl Werner, who has got an excellent record within the motor finance industry and indeed the wider financial services industry came out as the outstanding candidate. That's no reflection at all on internal or indeed other candidates. And in fact, we are looking at the moment at succession planning within the business, within the various specialities in that business. And we're absolutely certain that we have a number of very talented medium level and medium higher level executives who will fit those roles. So could we move on to next question, which is again from Maynard P, excuse me, which refer to just a 31% acceptance rate from 1.2 million applications for motor finance, which equals 372,000 acceptances. Actual new accounts are a small fraction of this. Why do so many successful applications not convert into loans being granted? Seems like Advantage offer only the best terms for a small minority of potential customers. And how does the 31 acceptance rate compared to past levels? Over to you, Raf.
Yeah, the last part of that question I'll answer first. It's fairly consistent, to be honest, between 30 and 35% acceptance rate. So that's fairly standard for us. It's a source of personal frustration that we can't penetrate those numbers of approved cases more than we currently do. I would say, though, that the market intelligence tells us that even though we approve it, at least half of those accounts that we approve are for people that we call kind of digital tire kickers, where they're actually testing whether they can get access to money. But by the time they get an acceptance, they'll go away and may not find a car, may decide that the monthly payment is something that they can't currently afford just now, so they step back from it even though we've approved it, which I think is fine. But you're still in a position where you've got 170,000 applicants that are still in the marketplace, and we're writing between 20 and 25,000 of those. That shows the competitive nature of the marketplace, and we would like to do more of those, but at the same time, we like to achieve the margins that we've currently got. And an old boss of mine once said that turnover is vanity and profit is sanity. I think we've got the right balance.
Good, thank you, so we're going to move on now to the next of Maynard's questions, which is how does the board view Aspen's ROCE to date? Division has been going for 6 years, absorbed capital of £100 million plus, but cumulative earnings to date have been less than £10 million. I mean, basically, I would say that we're very confident and very pleased with Aspen's ROCE, which is improving, and which we anticipate will continue to improve. I think it's slightly disingenuous in the nicest possible way to talk about capital of £100 million plus, because that's obviously hasn't been out all the time over the 6 years, and we're anticipating earnings coming in as a result of that, because that's the way that this particular business works. But I'll ask Chris to make comments on that.
I fully agree with that. I think ROCE is moving in the right direction. I think the business is doing more business now. It's also increased its pricing relative to the VOE increases that we've seen. So, yeah, the ROCE is going in a good direction. I think it's a smoother ride, or has been, in the last 4 years versus the first 2 years. So we are hopeful to deliver a good ROCE for shareholders over the next few years from the Aspen business.
I think it's a legitimate point, but with the caveats that have just been suggested. I mean, we want a ROCE of over 10%, and that's the objective, and that's where we're aiming for. But I think the other comment I should make is that it's the first 5 years, but it's not often that you can get into business off the ground and making profit from year one, which is what Aspen did. I have to give them great credit for that.
Yeah. Okay, so we now move on to Matt G's question. What is the value of the 15 beyond term loans at Aspen? And I'm going to ask Ed and Chris to address this one.
So I think just as a factual point, this is in the notes to our announcement. If you look at, I think it's note 8, The stage 3 loans, which are where these 15 loans hit, you'll see 15.6 million, a figure that's an increase on what it was at year end, but Aspen's quite a lumpy business. That figure's come down since the end of July. We're not expecting significant losses from any of those deals, which is in line with this being a nearly nil bad debt model. But do you want to say anything?
Just that it's a low write-off model. That's the way we operate it. People do trip into default, and then we manage them out, and we expect to have positive outcomes on those deals.
Thanks, Ed.
And default isn't always a bad thing, particularly if you've got a good low loan to value, and you can charge rates which were anticipated initially.
Yeah. Okay, so we move on to Maynard P's next question. An impairment charge of 6.8 million is described as lower than normal as per the preceding full year. Is this lower level actually the new normal, or are you expecting the impairment rate to revert into past impairment rates quite soon? Chris?
Yeah, I'm a bit of a gloomy character, so I always expect impairment to get worse. So it's a very good question, very pertinent question. I think I'm describing it as lower than normal in the first half this year. I think both businesses have done really well. So we've just discussed that we had 15 defaults, but none of them particularly in trouble at Aspen. Repayments behind that figure are actually pretty good if you look at the cash flow. And then at Advantage, we've been through some charts showing how healthy the cash is. And again, you know, their bad debts are lower than budgeted on Graham's chart. Also, the voluntary terminations, which is a consumer right under a hire purchase agreement, they're lower than normal as well. So I think they are lower than normal. I would hope that we could continue that lower than normal. And therefore, I wouldn't at the moment subscribe to this being the new normal. Rather, it's that the businesses, both of them, are doing pretty well.
Good, thank you, Chris. Next question is Daniel G. Good afternoon. The company's gearing has been gradually increasing in recent years. What is your ideal level of gearing, and what is the limit level of gearing, please? I'm going to ask Chris to address this, but I would just say overall that we've always been very conservative in terms of our gearing for a finance company. You know, we have an idea that 100% is quite an ambitious level of gearing, and we've always had a great deal of equity in our business, and that general approach will continue. But over to you, Chris.
Yeah, I totally agree with Anthony. Also, I'd say that we've always said that the exact gearing level would relate to the underlying asset opportunity. At the moment, we've got two good businesses with an asset opportunity in each, so therefore we may well get up towards 100%. The question also asked, what is the limit level of gearing? So within my financial facilities, banking facilities at the moment, I have a limit of 120%. So I hope that gives you some information that's relevant, Daniel.
Thank you, Chris. So we move on to the next one, which is Dave A, which is quite a left field question. So I'm going to ask Graham Wheeler to address that. But before I do, I must say that Graham has done a wonderful job for Advantage over the last 4 years. And I don't say that just because he happens to be leaving as an executive, although he will be staying on the board as a non-executive. I'm delighted to tell you. But he's done a wonderful job in circumstances which may have been quite trying. He took over just before COVID hit. That obviously had a major effect on the industry, just as it did on any industry. So he's done a wonderful job. And Graham, over to you.
Well, firstly, I appreciate those very, very kind words. I have to say, I love leading Advantage, and I love being part of the S&U group. And making the decision to leave the organisation was a very difficult one. But from a personal point of view, staying away from home, because I actually live in the Midlands rather than up in Grimsby where our offices are, staying away from home and that long journey backwards and forwards every week in terms of the journey actually gets quite wearing after a while. And I've said that to my replacement, Carly. The sooner he gets moved up to the Grimsby area, the better for him and the business. All of my friends and relatives have got to a stage where they've retired, and I'm being left behind. They're all going to travel around the world and do things. And when you're fully utilised and looking after a business like Advantage, you get left behind. And basically, I'm making some personal life decisions to take advantage and join my friends and family in terms of what they're doing, and hopefully lead some of their ideas moving forward as well. But as Anthony says, I'm not leaving completely. I'm delighted that I'm going to be staying on as a non-executive director at S&U, and that means that poor Carl is going to have me looking over his shoulder thinking I might have been able to do that better, but I'm sure that's not the case. Carl is an outstanding guy. I've known him for many, many years. He served on the board of the FLA for some time. He's hugely experienced and got a huge amount of drive, and is massively excited about taking up my role in Advantage. And I think the business is very lucky to have somebody of his calibre taking over my position.
Yeah, and thank you for those very kind words, Graham. I must say, on a lighter note, going back to Warren Buffett. Warren Buffett was telling a story about a friend of his, very long old friend, who had a business he wanted to buy, but he said wisely he refused to sell it to him. And the guy reached 90 and decided that he's going to retire. And he said, Warren Buffett said, 2 years later, the guy died. So he said, I've now told all my executives that that's the reason why you're going to stay on in the business well beyond 80. Because look at the consequences if you don't. Anyway, we wish.
But the good news is we don't overburden our non-executive directors, but we do stay in regular contact, which is great.
Yeah.
That's the most important thing, yeah. Okay, so let's move back to the more serious side, which is Stephen B. Do the regulators understand the cost of gold plating regulations they are imposing on exemplary businesses like yours? Thanks very much for saying that, Stephen. What impact would an incoming Labour government have on your business model? The answer is, I don't know in either case. I suspect that regulators are more naturally interventionist now than they were, say, 10 years ago, and have less of a sympathy for the free market, as I said earlier, than they used to. But I have no idea whether they really understand the costs of gold plating regulations. What impact would an incoming Labour government have on your business model? Well, I rather ironically hope that a Labour government would be more conservative than this one. And the reason for that is because the Labour government knows that they've got a very tight fiscal position in terms of government deficit and the government debt to GDP, and that the only way that they're going to produce money for public services and other things, increasing people's standard of living, is via growth in the economy. That's the only way it's going to be done. And unless they get that, then they are living with a zero-sum game, which they're bound to lose. So I would certainly hope that they would be pragmatic if we do get an incoming Labour government. And certainly I hope that if we don't, that the Conservatives will suddenly have a revelation and become more conservative than they do at the moment. So I think that takes us to the end of questions, doesn't it?
Yes, perfect. And thank you very much for that. I think you've addressed all those questions from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Anthony, could I just ask you for a few closing comments?
Well, who said it was last words for fools? And so I wouldn't really just have last words. We've covered a lot of the waterfront. Just to say that we are here for the long term. This is a business which we believe in for that, over that period. We're doing all we can to improve and to consolidate our service for customers, and we think that that will be rewarded by good returns, irrespective of current headwinds. So if I was a long-term investor, which we are, and I am, I would be quietly confident as to the future of S&U.
Perfect. And thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of S&U PLC, we'd like to thank you for attending today's presentation. Good afternoon to you all.